Hi, good afternoon, everyone. This is Lee Ding from Federal Reserve Bank of Philadelphia. Welcome to today's webinar on unemployment insurance. This webinar is a session in our Research for Equity in Recovery webinar series, which is co-hosted with the Upjohn Institute and the Penn RUR. I want to start with the standard disclaimer. The information, analysis, and conclusions set forth are those of the panelists and do not necessarily reflect the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. Before I start, I just want to hear a few housekeeping items. First, today's session is being recorded. After the webinar, the recording and other supporting materials will be posted on our website shortly. Second, based on the feedback from the previous webinars, the webinar is extended from 60 minutes to 75 minutes. So the webinar will end at about 1:15 p.m. instead of 1 p.m. So we will have more time for Q&As. So we encourage you to use the Q&A function that you can find in your Zoom toolbar to ask questions anytime during the session. The panelists will try to answer them after the presentations. Finally, it's my great pleasure to introduce the moderator of this panel, Michael Horrigan, who has been the president of the Upjohn Institute since March 2019. Prior to coming to the Institute, Dr. Horrigan had worked for 32 years in a variety of positions at the Bureau of Labor Statistics. I have to say, it has been a great experience working with colleagues at Upjohn Institute on this webinar series. We really appreciate the partnership and all the support we received. Especially I want to thank Dr. Horrigan and his staff at Upjohn for putting this wonderful panel together. And without further ado, I will hand over to Mike now.
Thank you, Lei. And thanks to the Philadelphia Federal Reserve for sponsoring this series of panels on research for equity and recovery. As Lei mentioned, this fourth panel focuses on UI during the COVID crisis, in particular lessons for improving the UI system. Clearly, the impact of COVID and the COVID crisis on the overall US economy and on the US labor market has placed a great deal of stress on the UI system. Today's UI report shows initial claims holding at about 884,000 and continued claims rising slightly to about 13.4 million. That is for workers that are traditionally covered by the UI system. Since the surge began, these traditionally covered workers, initial claims have totaled more than 60 million. Initial claims for pandemic unemployment insurance, those which benefit workers not traditionally covered by UI, rose for the fourth straight week, from 490,000 to 839,000 this past week, the week ending September 5th. And over at the same time, for the week ending September 5th, continued claims for all programs stood at 29.6 million. So today's speakers are going to focus on different aspects of this crisis. Suzanne, Simonetta, and I'll be reading their biographies in just a moment, from the Department of Labor, will look at the administrative challenges to the UI system and responses to those challenges during this crisis. Patty Anderson of Dartmouth and Chris O'Leary from our Upjohn Institute will focus on what has happened in terms of the response to the UI system, the pressures on the UI system in terms of benefit ratios and other aspects, and we'll look at some of the lessons learned in terms of potential reform for the UI system in the future. So let me introduce the panelists, and I'll read them in order of their presentations. Chris O'Leary is going to go first. Chris is a senior economist at the Upjohn Institute, and his recent research has focused on interactions between UI and public assistance. He's currently working on behavioral nudges and customized employment assistance in Michigan, UI benefit financing in Maryland, and targeting reemployment services for the US Department of Labor. Suzanne Simonetta is the director of the Division of Policy, Legislation, and Regulations in the Employment and Training Administration in the US Department of Labor. Since the onset of COVID, her work has focused on UI-related provisions in the Coronavirus Aid, Relief, and Economic Security Act. Previously, Suzanne was the Chief of Legislation in the Office of Unemployment Insurance. And our third speaker, Patty Anderson, is a professor of economics at Dartmouth and a research associate of the National Bureau of Economic Research. Her interest in UI was sparked while working at Mathematica on the New Jersey UI Reemployment Demonstration Project. She ended up writing her dissertation on UI incentives, followed by many more publications studying UI. Most recently, she served in the DOL UI Technical Working Group studying UI benefit adequacy. So as you can tell, we have a stellar panel of experts, and we will begin with Chris's presentation. Chris? Oh, sorry, just one other quick thing. If you have questions as the presentations are going on, please submit them in the Q&A box, and I will be monitoring those. When the presentations are finished, I'll have a couple questions for the panelists to begin, and then we should have plenty of time to get to all of your questions from the Q&A section. Chris?
Thank you, Mike, and I want to thank our colleagues at the Philadelphia Fed for organizing this session this midday. I'm going to start by giving an overview of unemployment insurance in the pandemic. And I have control. Okay, before the pandemic, the federal state unemployment insurance system had been declining. Tax revenues down, benefit amounts down, benefit durations down, recipiency rates down. The system was not prepared for a pandemic. You can see in this graph over the last 45 years, the average tax revenue as a percentage of total wages in states, about 1.2% back in 75, most recently about half of that. The benefit levels have followed deteriorating financing. Recipiency has also declined over this period. That is, the fraction of all unemployed who are beneficiaries. 40 years ago was about 38%, most recently less than 31%. And this story resulted not because all states' systems declined. Some state systems deteriorated, while others maintained relatively high recipiency rates. When you think of all the unemployed, it's not just job losers, it's also people who quit their jobs and would not be eligible. It's also new entrants to the labor force and people re-entering who might not have recent earnings to qualify to pay the premiums. But the average in some states, and if you notice, these are mostly in the Southeast, Florida, North Carolina, recipiency rate in recent year is only about 11%. New Jersey and Pennsylvania, some states in the Philadelphia Fed region, have much higher recipiency rates. And it's worth noting that in both New Jersey and Philadelphia at times, there is not only an employer tax to finance unemployment insurance, but also employees pay taxes. So every paycheck that someone in New Jersey receives, they see a withholding for unemployment insurance. So they know they've paid the premiums and they're going to get benefits when they're unemployed. The inadequate financing, some states have cut benefits and allowed systems to decline. States with inadequate financing usually pay lower benefits. Interestingly, there's no federal requirement for benefit amount or durations. This is something I will hear about later in the program. Why has UI deteriorated? Well, the great moderations. Recessions are less frequent. There's also occupational segmentation and the risk of unemployment. Some people feel they'll never be experiencing unemployment. And so there's not a lot of public pressure to maintain adequate systems. And there seems to be a dichotomy between states in the philosophy about unemployment. Is it a labor market support program, or is it a business cost to be minimized? In terms of forward funding for the recession, or any recession, nobody planned on a pandemic, but any recession, the federal government has guidelines. And the guideline is that you should have at least 1 year of reserves that would pay benefits in a recent average recession. Among that, 27 states were adequately prepared at the beginning of this year. All these other states did not have adequate forward funding. And without adequate forward funding, financing can be pro-cyclical. That is, you're trying to raise revenues during a recovery, so you're putting pressure on business. The idea is if you build up reserves during a recovery, that dampens the upswing, and it does not dampen the recovery on the other side. So far, 19 states have applied to the U.S. Treasury for borrowing already. 11 already have received advances, so states are hurting. The average wage replacement rate is 40% or higher in only 14 states. The principle of wage replacement, and we'll hear some about this from Professor Anderson in a bit, the incentives, the idea of unemployment is that it should replace about 50% of lost wages to balance work incentives and income replacement. Only about 14 states provided at least 40%. I tried to do this with a half wage replacement on average, and the wage replacement rate is really governed not only by the rule below the maximum, but the maximum. And many states have an indexed maximum weekly benefit amount, but many states have overridden their maximum, which leads to this low average replacement rate. During the pandemic, the Families First Coronavirus Response Act added money for administration, recognizing first that states would have difficulty in processing all the claims. Money was put into that. This about doubled administration, but trying to beef up administration overnight is difficult. These systems have legacy computer systems, and some have new computer systems, but they were just overwhelmed. The previous high ever in a week was about 1 million claims. We know that in mid-March, we had 6 million claims. Nobody was ever prepared for a pandemic, a complete economic stop. Coronavirus Relief and Economic Security Act, the CARES Act, added PUA, Pandemic Unemployment Assistance for the Self-Employed and Gig Workers. This is a characteristics of disaster unemployment. These people are not traditionally covered, and it picked up many others as well. The FPUC, the federal pandemic, we've all heard about the $600 a week. Will it be extended? It turns out that FPUC, there's been $270 billion pushed out as FPUC during the crisis since March. Last year, a total of $30 billion was paid out in regular state unemployment benefits. Since March, there's been about $100 billion paid out. So if you look at all the elements of the CARES Act, it's about $328 billion pushed out, with $100 billion pushed for the federal, for this regular state program. And Larry Schimmerin produced some estimates of the multiplier for unemployment benefits, and it's about 2.5. So this money filled about $1 trillion hole in the GDP during the crisis. We can maybe later discuss how it compares to the PPP. The CARES Act also had money for extended benefits, but the characteristic of raising income replacement in this crisis, as opposed to the extended benefits, which has been done 8 or 9 times before, is an important characteristic here. The work sharing benefits are fully paid. If states have programs, about half do. Nonprofit and government, about half of their benefit payments were paid by the CARES Act. These are the elements of the CARES Act in statute. The comments, the volume of claims more than tripled on average. The wage replacement increased. Whether or not there's disincentives for return to work, the evidence, Patty will talk about this, doesn't seem to be a lot of evidence for that. Job demand was flagging in this period, but social distancing was maintained, and the federal reimbursement programs. If you look at the wage replacement with the FPUC on average, you had about 18 states with full wage replacement. Again, this maintained social distancing and maintained economic security in households as they sheltered in place. This is the weekly report from last week. As Mike said, the number is about 29 million total, less on the regular state. more on the pandemic, it's interesting that the work sharing has not been used, and we can talk about that in the Q&A, has not been used as much as we would have expected when it's fully reimbursed. After the crisis, what will we learn? Well, improving the application process and benefit payment systems. We could simplify eligibility rules to improve recipiency and add benefit standards as a national rule. Improving financing to improve experience rating and forward funding of benefits. While we might not have to plan for a pandemic, we need to be at least prepared, and we can see that even a normal recession would have been difficult at the beginning of this year. Adequately funding reemployment services, which we haven't mentioned. Make work sharing and self-employment programs required under all states. Evaluating coverage to contract self-employed, using what we learned from this crisis to study that. And consider a case for a federalized system. If we can't make the federal state system, this has to be on the table with uniform eligibility, financing, benefits, and administration. And like Pennsylvania and New Jersey, considering employee contributions to overcome the allergy to public finance around unemployment insurance. Thank you. I'll pass the baton to my colleague, Suzanne Simonetta from the U.S. Department of Labor.
Suzanne, you're on mute.
Hello, pleasure to speak to you all today. Anyhow, I'm going to start, once I get control here, with giving you a little bit of background information to kind of help understand why we had this patchwork of federal interventions to respond to the economic effects of the pandemic. And the first main point I want to share with you is that unemployment insurance is a federal-state partnership based on federal law, but generally speaking, administered by states under state law. So what this means is that unless federal law has an explicit requirement or prohibition about something, states have authority to establish their own program parameters. And so what we find is that for many of the key policy areas in UI, and Chris did just talk about this, we see a lot of variations among the states with a lot of key aspects of the UI program that will affect recipiency and other measures with respect to the UI program. We don't have federal requirements about weekly benefit amounts, number of weeks of benefits, and so that's kind of why we see what we see out there. And so obviously we have this high variation among the states. And so when we're dealing with a crisis situation, it's important to keep in mind that enactment of a federal statute or a change to federal policy is not going to automatically result in conforming changes to state law or policy, because states may need to amend their UI laws, and it may take time, and depending on the state and their legislature's calendar, you might not have an opportunity to make any of these changes until the next calendar year when the legislature is back in session. So in a federal state system like this, there is this challenge of how do you get nationwide changes implemented quickly when we have to deal with not just federal laws, but state laws. All right, the other thing that I think is really important to keep in mind when thinking about unemployment insurance is that this program is really not compatible with a health-based unemployment crisis. And this is the first time we've ever experienced something like this. I think it's important to keep in mind that the permanent UI program is designed to help involuntarily unemployed individuals who have been recently attached to the labor market and who continue to be attached to the labor market. So that's really the risk of unemployment that is being covered by the standard UI program. And so this is why when you think about some of the eligibility requirements for the UI program, individuals must have earned sufficient recent wages, and they generally must be able to work, available for work, and actively seeking work in order to be eligible for benefits. So in a situation like we're dealing with right now, if someone is sick, if they're caring for a child, or if they must self-quarantine so that they can't actually go to work, they would not be eligible for the regular UI program, because if you're sick, you're not really able to work. If you're caring for children or you must self-quarantine, you're not available for work. And so it's really not a perfect fit. And I also want to point out that this is a reason why, generally speaking, self-employed are excluded from coverage from the regular UI program, because in a normal situation, how do you know if someone who's self-employed is involuntarily unemployed? Is it just that they wanted to take a break for a few weeks, or is there really no work for them? Clearly, things are different in a pandemic, but in normal times, it's really hard to make that assessment. Okay, so understanding these basic elements of the permanent UI program, we now have a better, framework for understanding why it was necessary to have new federal programs to achieve policy objectives during the pandemic. So if you want to expand access to benefits, well, that's why we have PUA, because it enables not only the self-employed, which is where most people are hearing about the PUA program, but it also allows recent entrants to the labor market, certain long-term unemployed individuals, and other individuals who are not eligible for regular UI to get access to benefits. So for example, if someone is not eligible for regular UI because they are home caring for a kid whose daycare was closed, the regular UI program in the state might not be able to accommodate that person getting access to benefits. But if you're unemployed due to the pandemic and you're not eligible for regular UI, PUA may be available to you. Similarly, if you want to increase the generosity of benefits, then that's why we have FPUC, which significantly increased weekly benefit amounts. That's $600 a week, which also provided for greater macroeconomic stabilization in addition to helping jobless workers. Also, if we wanted to increase the duration of benefits, the number of weeks that are available, because remember, there's a lot of variation among the states, that's why we have the PIAC program, which I know hasn't yet really gotten as much attention, and it provides 13 more weeks of benefits to individuals who've run out of their regular UI benefits under state law. And just as a brief kind of note, I just want to at least mention the Permanent Extended Benefits Program. It provides up to 20 weeks of benefits, and during a typical recession, the permanent program doesn't generally trigger on often enough in most states, and so that's why temporary emergency federal extension programs are often created during recessions. Given our current situation, that hasn't been the experience. EB has been triggering on, but I did at least wanted to acknowledge that program. Okay, now I want to move on a little bit to talk about some of the administrative challenges of these temporary interventions. Given the structure of the system that we have and the risk that it's designed to ensure, we understand why we needed to take these interventions, but we also know, sadly, that implementation of some of these new programs didn't go smoothly, took some time, and obviously from an unemployed worker's perspective, it's been incredibly, incredibly difficult. But I think it's important to keep in mind how unprecedented claims levels have been during the pandemic, particularly in the early weeks. We found that for the regular UI program, nationwide initial claims increased by more than an order of magnitude in 1 week. So nationwide, we went from about, 225,000 claims, initial claims in a week, which means people who are first filing for benefits, and then the next week it was over 1 million. And we know people were having trouble accessing the system, so that didn't even capture everyone who was applying. And then we saw a couple of weeks of having 6 million initial claims. I mean, this is something that was just never even close to experienced in the UI program. And so I say this with care because, once again, I understand the genuine human impact on the administrative challenges that individuals faced, but really, states shouldn't have been prepared for this volume of claims. The UI program has been around since 1935. In all these years, never was there anything like this. And I think it's also important to keep in mind that administrative funding for the UI program generally comes from the federal government, and it's workload based. So how much money states get to run their programs depends on how many claims they're really having. And so it would have been a waste of public resources to have had built-in capacity for a level of claims that had never even been close to being experienced in the UI program. And the next thing I want to point out is that the UI eligibility determination process is complex. A lot of things can be automated to simplify and speed up the process, but it's not a one-size-fits-all program, and there are many requirements that one has to look at when determining if someone is eligible under state or federal law. And it takes time to hire and train staff to make eligibility determinations based on the unique circumstances of each individual who applies. Now, you may have heard that states were, literally working 24/7 to try to come close to meeting this demand, but it really does take time. And I think it's important to remember that you need trained, skilled people to make these determinations. And also, it takes a lot of time to implement new federal programs. Federal guidance must be issued, and states must program their systems and train their staff about the requirements before they can begin to process claims. Now, I can tell you, we at the federal level started working on the guidance once we had a pretty good idea of what the CARES Act was going to look like, that the legislative language was final. But these are complex programs, and this all takes time. Similarly, PUA is a very complex, novel program. Although there are similarities with the Permanent Disaster Unemployment Assistance Program, there never has been a health-based UI program before. And establishing eligibility for the self-employed isn't easy, especially given the number of gig workers who applied. So we really were dealing with uncharted territory in many ways with respect to the UI program. And the next thing, which is an acknowledgement that I think has been pretty widely covered, is that many states do have archaic IT infrastructures. And without dedicated federal funding for modernization efforts, states generally need to commit a substantial amount of resources to update their systems. And these updates are often multi-year initiatives. It just takes time. And I also want to bring up another important point, that program integrity matters, and that it really is essential to have reasonable procedures that are designed to reduce the likelihood of fraud and to ensure that benefit payments are being made properly. Unfortunately, we have heard that there have been some massive organized schemes to defraud the UI system. And so unfortunately, we deal with a situation where there's an inherent trade-off with operational simplicity and ease. If the whole process for applying is easy, that will probably speed things up, which is great because you want to get this money into the hands of unemployed workers as fast as possible. But if you're not fully, is checking everything that you need to for each individual's claim, then there might be some problems with whether or not that claim is a valid one that should be paid. So it's just one of those situations that are very, very hard to manage. And the last thing I want to mention briefly is that the pandemic affected federal and state agencies too. That we all had to change how we conduct business by shifting to almost 100% remote operations overnight without any time to prepare. And we had to build capacity to respond to the economic effects of this crisis while the crisis was affecting all of us. Some of our employees or their family members were sick. They've had COVID. People have to balance work with parental obligations, just the general stress of pandemic life, and the pressure to serve the public when most needed. One thing I can say with confidence is that the UI system nationwide at the federal and state level is full of dedicated professionals who are committed to serving the public. And it's when the economy is down, that's when everyone is needed most. And there is this strong public service orientation to help people most. And it's been a big challenge in current times. All right, so what have we learned so far? Number one, this is just not a normal recession. So really, some of the old rules that we knew about program and how to analyze impacts just don't apply. And while previous program reform efforts focused on some of the policy areas addressed by the UI provisions in the CARES Act, however, an unemployment crisis of this scope really hadn't been contemplated before. So it's really a great opportunity to even think once again about what is necessary should we ever experience something even remotely similar to what we're experiencing right now. Also, I think would be very helpful if we had more automatically activated interventions, because it would be much easier to implement than a new emergency program. It would greatly reduce preparation time because you could essentially flip a switch. You would have the IT programming done. You would have all of the operational instructions and guidance out, and that would just make it a lot easier for these interventions to have an impact quicker. And the last quick point I'd like to make is that an investment in administrative infrastructure is critical. It's incredibly difficult to address these matters during a crisis. It's kind of like, replacing your roof in the middle of a Category 5 hurricane. Yeah, if your roof is leaking, you're going to do what you can to patch it up during the storm, but really you kind of need to, if whenever possible, to try to make these, improvements and protections available before the crisis hits. Thank you. I welcome your comments and questions later.
And we'll turn on to Patty, but I just want a reminder for the folks that are listening to the presentations. At the end of Patty's remarks, we will have a quick Q&A from me for the panelists, and then we'll turn it over to everyone for their questions. So if you can submit any questions you have in the Q&A box, that would be great. Patty?
All right, thank you. And so I'm going to wrap up this panel section by looking at what actually happened once we had the CARES Act. And so, as I'm sure we all know, initial claims just skyrocketed, right? So Suzanne mentioned that this was unprecedented, and you can see that that first week they shot up to 6 million, they stayed high, and they've only slowly come down. If we were looking at towards the end of this graph, without that lump in the beginning, we would have thought, wow, that's a huge increase in UI. So it's reasonable that they weren't really prepared for this. If you then look at sort of how this split up among the different programs, you can see that the new PUA that was for people that wouldn't usually be able to get UI started becoming a bigger and bigger aspect of this. So the state UI shoots up right away, and then PUA starts increasing. And so this was a big deal, as you can tell. Now, Chris mentioned that recipiency had been declining, and you can see that it's really recovered. And this is a little bit misleading because, as Suzanne mentioned, there's a lot of the complexity of the programs and the ancient infrastructure and the IT programs led to a lot of delays in people getting their benefits. And so this is sort of benefit weeks. And so you occasionally are getting people getting multiple weeks at once, so they're sort of double counted in this chart. But I'm using the same format for January and February, and so relatively we're getting the idea of how much recipiency is going up. So are we completely surprised? Probably not. If you think about how much more benefits are worth with FPUC, the extra $600, and of course this was set to, on average, give people 100% replacement. In that first quarter of 2020, the average weekly benefit amount was $373. The average wage was $973. Boom, $600 gets you full replacement. And so that's a huge increase, right? That's about, on average, 160% increase in your weekly benefits amount. Work that I've done back in the dark ages told us that just a 10% increase in weekly benefits could increase take-up or recipiency by 2 to 2.5 percentage points. And so we might expect maybe a 30 to 40 percentage point increase in the take-up rate. It was mentioned that eventually PEUC is going to kick in with an additional 13 weeks. Increases in potential duration can also increase take-up 0.5 point to a point. And so altogether, this might predict that would get you up to about 70, 80% recipiency the way this is being measured. Now, by April, that's about where we were, about 80. By July, it's looking like we have almost 100%. Again, this is a bit of an overstatement because by July, almost everyone that's claimed is getting their weeks. So what else is contributing to an increase in recipiency besides sort of increased benefits and duration, and also having a slight overstatement in the version that I have here? Well, the costs of applying were down a little bit. One, the waiting week is waived. A lot of people in normal times would think, oh, I'm going to get a job any moment now, no point in applying, having to wait for a week, and then getting UI for a couple weeks and I'll have a job. Also important, the continuing eligibility conditions were loosened both via PUA and a lot of states just in general did that by saying, we need you to stay home because of the pandemic, and so you don't really have to search for work. If you have to stay home with a child whose school is closed, you're going to be eligible. And so the increasing eligibility obviously is going to help it. Also, the base of my calculation is a little bit undercounted because it's difficult to exactly measure who's unemployed when in this pandemic, not everyone's searching. The BLS admitted to some simple misclassification of temporary layoffs, but there's also just the way people would have reported. They're not on temporary layoff, they're not looking, but only because their state is locked down. And then similarly for the people that are eligible via PUA, it's a lot harder to see how they might be recorded as unemployed. So all of this kind of combined to make it look like recipiency is way up. The important part, and I think that made a lot of press, was the replacement rates with this $600 fixed increase in benefits. And so this chart, what looks like 13, that very high number at the beginning, is actually based on a state's minimum wage, and then each hourly wage from there on out, $1 at a time. I ran through a benefit simulator from some folks at the Becker-Friedman Institute at the University of Chicago, and then just looked at what state had the maximum replacement rate and the minimum. In the red is pre-cares. And you can see that at the maximum, most states, even up through $35 an hour, are keeping at least a 50% replacement rate. But the most stingy state, basically the person at the minimum wage gets a 50% replacement rate, and it's all downhill from there. With the CARES Act, these shift up. And you can see that even in the stingy states, you're getting 100% replacement rate up through about $20 an hour. And in the generous states, that's closer to over $30 an hour. And so perhaps not surprisingly, given these much higher replacement rates, there was concern about people not being encouraged to go back to work. So that's just the numbers that were in the chart for future reference. And this isn't a crazy concern because there's lots and lots of economic literature telling us that benefit increases increase unemployment duration. This is a nice review piece from Johannes Schmeider and Til van Wachter that looks at what this elasticity is. And there's a range depending on how they do this, but at the median, it's basically around 0.38. And so that would have implied a 61% increase in duration. And so probably not surprising, people were concerned that people were going to stay unemployed instead of going back to work. Normal times are not current times, as I think Suzanne was making clear. And so people have started studying FPOC directly. And it turns out there's actually no evidence of this huge increase in replacement rates leading to people avoiding becoming reemployed. There's a nice paper by Altanji, Contractor, Finnemore, Haggard, Linden Love, McGeer, O'Day, Scott, Wang, and Washington. And they're basically seeing no disincentives for returning to work over time. One by Dubé looks sort of across states and finds essentially nothing. And another one by Marinescu, Skandalis, and Zhao find again that applicants for vacancies employers didn't lack applicancies for the vacancies, even though there's this huge increase in employment benefits. So on the bright side, it does seem like we managed to increase the macro stabilization without really having trouble. Couple quick things about other incentives that we normally see. Usually see experience rating leading to lower layoffs unless you're at the maximum rate. It provides an incentive to police your worker claims. With so much of the benefits being paid by the feds that are not experience rated, or states choosing not to charge benefits to different employers, a lot of those typical firm incentives aren't really in play. And so what do we need to think about going forward? You know, whereas we didn't seem to have much of an impact on unemployment with the big increase in UI, there was some concerns about the people who did have to work at their essential low-wage jobs, having very low morale. Perhaps we, in pandemic time, should have thought about, you know, hazard pay wage supplements for those low-wage essential workers. We probably want to think about obvious triggers that increase benefits, not just duration. It did a really good job of the macro stabilization side of things. And then finally, as was brought up by other people, you know, we're not doing a very good job of having enough money in the system. It's possible that the very low tax base is which makes nominal tax rates high, increases employer resistance. Maybe with a higher tax base, would have less if, as Chris mentioned, if workers could be sharing the burden, then they might consider themselves stakeholders and lobby to have more payments. And then, you know, as also was mentioned, this also raises issues of who all should really be eligible for UI. So I'm out of time. We've got references to what I'd mentioned in the slides, but I'm not going to put them up.
Great. Thank you, Patty.
Thanks.
So before we turn to the questions, we have some questions coming in. And one of the things that I love about these questions is that they actually match some of the questions that I wanted to ask as well. But I wanted to start with a slightly larger one in terms of combining what I've heard from Suzanne, Chris, and Patty. So Suzanne, you made a very convincing argument that the UI system the day before COVID was not designed to respond to this kind of health emergency in terms of the magnitude of the claims that we're seeing, as well as the kinds of aid that we needed to bring to people in terms of things like pandemic unemployment assistance for the self-employed, extending benefits, having a supplement to benefits in order to encourage people to stay at home and sort of maintain income and have a stimulus to the economy, for example. And one of the arguments you make is that not only is it that it was a system not designed for that to begin with, but the state nature of the system requires that states often would have to change their state laws, which takes time, to respond to this kind of pandemic, this kind of crisis. And I kind of wonder, and this may end up being a more appropriate question for Patty and Chris, But in some ways, with all of the programs that we've added in response to this pandemic, where we couldn't rely on the states individually all doing it at once, haven't we sort of federalized this system currently in terms of the totality of the programs that we've now introduced? We have a very large segment of the UI system that is now a federal-based program. And I'm wondering if sort of overall your view of where do we go in the future? Are we going to dismantle these programs? Or are these programs ones that will be part of the federal state system that sort of give that federal ability to respond to an emerging crisis if we have a second wave, a third wave of the pandemic? Are we sort of federalizing the system already at the moment? Suzanne, you're on mute.
Yeah. You can hear me now?
Yeah.
All right. Well, that's a really good question. And I think what one can say is that clearly in this recession, in the Great Recession, and frankly, in just about all the previous recessions, when it comes to economic downturns, the response is heavily weighted on a federal response rather than a state response. Even the permanent extended benefits program under normal circumstances is 50% federally funded. But I think the question that maybe you're indirectly asking is whether some of these federal interventions during downturns, whether they should be made permanent elements of the UI system or whether we should continue to have ad hoc temporary emergency programs enacted. And I know in prior UI reform efforts over the years, there have been some talks about whether reforming the permanent EB program in a variety of ways and making some other systemic changes that would not only make changes potentially in perpetuity for any time there's an unemployment spell, if for example, there were standards set for benefit levels or whatnot, but trying to have a more permanent response available for downturns. And frankly, we all have opinions about what would be the best approach, but I think it's really a matter of wait and see. Clearly, this is a huge issue, and there will probably eventually be partnerships with Congress and the administration and the states in thinking about what might be the best path moving forward. Once we can catch our breath and get out of this crisis, hopefully enough interest and momentum can remain to keep thinking about the UI program and get it better positioned for the next recession, because sadly, we never escape economic downturns. All we can try to do is be increasingly better prepared for the next one.
Patty, Chris?
Speaking of sort of federalization, in some ways, though, when thinking about automatic stabilizers, some of the past talk has actually kind of gone the other direction, which is that you need to target micro areas automatically, because when sort of by the time a whole state, if you turn on extended benefits there for a whole state, there may be a portion of the state that actually was hit by the demand shock that needs it, and another portion that wasn't so much. And that's when you get the bad incentive effects. If you're getting the extra benefits and the extra weeks in an area that's not really being hit so hard. And so I think you have this tension. If we more federalize the system, there's going to be more potential for the poor incentive effects to kick back in. But I think you do want to be automatic. But the question is, do you want to micro-target a little more?
And Chris, any comments? And I'll turn it over now to the audience questions.
Yeah, I think there's been allusion by both Suzanne and Patty about the tensions in the system. I want to pick up on what Suzanne said about the fraud, the overpayments, the improper payments. There's pressure in the system to pay benefits when due. And people don't always meet all the eligibility requirements. However, a lot of those eligibility requirements were suspended in this situation, in the current situation. But that doesn't mean that we can't improve administrative systems. Part of what I wanted to show in showing that graph of recipiency rates across states was a degree of administrative preparation. Some of these states were a little bit more prepared to handle claims than others. And certainly over the years, the federal government has given out periodic grants for IT improvement and so forth, but it's been uneven. And some of that, I think, could be improved. And if the systems were more flexible, anything that's changed at the federal level, like Suzanne said, you know, fixing the roof during the crisis when it's raining out is tough. But if the systems were more flexible, those could be accommodated. We don't want to open the doors. And what we've seen in the current situation, you know, when I first started doing it back when Patty ran a bonus experiment and I ran one in the 1980s, or I was involved in one. And back in those days, people had to come into the office when they wanted to claim benefits, and they had to show their face, and they had to prove that they were seeking unemployment. And actually, every 2 weeks, when they certified, they had to say that they contacted employers. And there was actually there used to be a cash window in the office. There's like a little teller window where you'd go and you'd get your dollar. They pay in dollar bills, actually Federal Reserve notes here. The fellow Billy Fed would know about that. But you know, now we've got all these automated systems, so it makes it easy to set up an operation in Russia or anywhere offshore where you can apply an automated way and you can get your deposit directly. Now there's pressure because this timeliness thing, and the states are under pressure to get the checks out. And you know what that has led to is simplifying some rules, which may be necessary to avoid overpayments, but it's balancing these things. So anyway, I don't know if I've answered, but Mike, I agree with Suzanne that there are hurdles to be overcome, but I think with improved systems, a lot of these things could be addressed properly and to provide access. And I guess, yeah, maybe we'll get to it later in the about access for the lower wage workers, because one point that I want to mention is Patty said properly is that the average benefit was $373 when this crisis started at the end of 2019, beginning of 2020. Right now, the average benefit is $328. And that's because the composition of the unemployed and the beneficiaries in this crisis have been more on the low end. There's been a shift toward low wage workers, particularly from retail and hospitality, and a shift away as a share of all beneficiaries from manufacturing and construction, which were much higher wage industries. And, you know, we've done some research, you know, at the Upjohn Institute, Mike, about how just getting in, some lower wage workers just getting into the system to get unemployment, it prevents them from relying on food stamps, relying on TANF, and that's another thing that we can talk about. So thank you.
So there was a follow-up. There was one of the questions that is kind of a follow-up to what Chris was saying, and I don't know, Suzanne, if you have an estimate of this, but Joel asks, is there a rough national estimate of the share of initial claims since mid-March that are the result of cyber fraud? Do we have any data on that?
I'm not sure if we have comprehensive data on that yet, or if we ever will. Obviously, states do have established procedures for trying to prevent, identify, and then recover all improper payments, whether due to fraud or due to other reasons. But whether we will ever get the granular data on exactly how many are due to one particular type of fraud, I'm not sure if we will have that information available.
So one of the other questions is related to what Chris was talking about when you were talking about, Suzanne, with the problems with the IT infrastructure, the modernization efforts by the states, the lack of funding in order to keep those modernized. And to some extent, there's an argument that could be made that even before the pandemic, the state systems were even then in dire need of being modernized. The question from Gail is, does the 2020 return to work research account for the delays, sometimes months long, of actually getting the benefits and getting the $600, and how that might be driving people back to work just to make ends meet?
Well, I guess first, if I could just speak just a little bit to, I guess, pre-pandemic administrative issues, because just as with everything with UI, not all states were in the same position administratively. And I do want to point out that some states have relatively recently modernized their systems. Some may have done it in the early 2000s, but that's now becoming dated. And then there's still a significant number of states that have even older IT systems that are maybe in varying stages of developing new IT systems. And obviously some had more maybe profound challenges in their experience in the early months of the pandemic. So I think it's important to keep in mind that not all states were in the same boat previously. But going back to the question, I don't know if you could just restate it briefly.
Well, I think the concern is that this idea of return to work and the disincentive effects, there's a countervailing notion that if you call the UI system 300 times a day, as I've heard, and you had trouble getting your benefits, that itself could be driving coming back to work because you have a significant delay in getting the income that you need.
Yeah, I don't know if that would have been a huge issue in March, April, May, when I think people were experiencing their biggest administrative challenges. Right. And that's a time when a lot of businesses were shut down, either as required by the state or just because business demand dried up. So I don't know if the timing would have been right for there to have been enough opportunities for people to either continue working or remain working while they were experiencing that initial challenge of just getting that claim filed.
We have two questions that are related, and I definitely want to get to the first one from Ralph because he was the first one that put a question in the Q&A box. But both Ralph and Balducci ask about short-time compensation, and one of the questions that came out, of the way it was written up, is whether or not STC can be used to bring employees back, as well as the traditional use of STC to prevent layoffs in the first place. And I know we've done research. Susan Hausman at Upjohn has written a lot. So has Chris and Susan with Catherine Abraham have written a lot about the use of STC and encouraging employers to think about using it in terms of bringing people back, especially when they don't have a full-time schedule. But I guess the core of the question is, with the ability of STC as a way of handling how you either prevent layoffs or how you bring people back to employment, why is it not being used as much as people thought it would be? Well,
if I may take a stab at answering this question, I think it's a challenge. And I think the first thing we need to remember is that not all states provide for STC. And for those of you who are not familiar, short-time compensation is essentially a variation on unemployment insurance, where someone whose hours at work are reduced would get a prorated share of their weekly unemployment benefit. So, for example, if you're working 3 days a week instead of 5, you have a 40% reduction in your hours, you could get 40% of your weekly unemployment benefit, which normally wouldn't be available to you. So I think the first reason why I'd say that, number one, STC probably isn't as broadly used is that not all states have it and offer it. And I think another challenge.
Suzanne, just as a quick FYI, if a state doesn't have an STC program, they can use the federal system.
Well, there's a federal program that is authorized in the CARES Act. A similar thing was authorized during the Great Recession. We didn't have any states take up the federal program, and there's some probably very specific program design reasons for that. But it is technically available through the end of the year, but we did not have any states take that up. But I think the other general challenge for STC take-up, even in states that have it, is that generally speaking, this is a proactively planned use of the program where an employer will submit a plan to the state before they're reducing work hours, and then they will be approved by the state, and then the benefit payments will start. Now, I do know anecdotally that there are a lot of states that have had a significant amount of STC usage. It's just it's not something where you can just flip the switch and automatically one day have everybody using STC. It's a process where the employer and the state have to basically work together, have a plan that is approved. Now, I will say that STC is a priority for the administration. And I know there's been a lot of thinking about how to expand its usage in a pandemic environment. I know we have issued some guidance already about STC, and and it's something that we're continuing to work on to try to be a little bit more creative in supporting states and employers to more broadly use it in potentially a reopening scenario where businesses are bringing their workers back, but maybe at reduced hours.
So Patty and Chris, I don't know if you want to comment on the STC. I have a different question to ask the two of you.
Yeah, I just want to say to our broad audience that the action on the short-time compensation to work sharing in this CARES Act and also in the Great Recession, the incentives for states to establish programs. I think in the Great Recession, there were 19 states, and I think now there's about 26, 27 states that have short-time. The objective is to let short-time compensation be a macro tool of policy, a macro policy tool, so that the federal government, maybe instead of extending benefits, could say to employers, look, if you have to lay people off, just lay off a fraction of them, and it won't affect your tax rate. We'll pay all those benefits. And so that's what was done in this case. And this whole issue of tax charges is difficult in this instance because a lot of states suspended charging of benefits. So, I mean, that's number one. That may be a number one reason why there weren't as many states or as many cases of work sharing. So there's about 30 million active claims in the past several weeks, and only about less than 500,000 of those are work share claims. And the question is, why not more? And again, the return to work, and again, at least up until the end of July, if you got a work share benefit, if you got the 40% of your unemployment, you got the FPUC too. So you got the extra $600. So it's a great mechanism for employers to build solidarity with their workforce. Instead of laying off 40% of the workforce, and the 60% who are still working point to them saying, hey, they're getting a lot more on unemployment. If everybody had the work share, everybody would benefit in this case. And again, the purpose of the FPUC was to promote social distancing, economic security during this crisis, and we have evidence that there was no disincentive effects. So the FPUC in work sharing should have been used more widely. And I think it's an informational thing. In Europe, it's the number one tool. And Patty mentioned in some of our warm-up meetings, another aspect is that the first impulse from the federal level, and Suzanne mentioned this, is to extend benefits. This has been done since Eisenhower. I think there's been at least 8 extended benefits. But we see, and Patty suggested, I think wisely, why not, if it's a crisis where there is no labor demand and it's a severe crisis, why shouldn't the first impulse be to boost wage replacement? There are good reasons why in normal times wage replacement is 50%, but 100% makes sense when you're trying to keep people home and safe. And the short-time compensation is another impulse. These maybe both should be considered before extending durations for economic reasons.
Patty, last word on this question? No? Okay. So we have a question that's related to some of the material that you presented, Chris, in terms of just the adequacy of the financing of the system, and in particular, the impact of the rules of the game on what employers have to contribute. Tiffany writes that state coverage for UI benefits for both contributing and reimbursing employers are ending. Contributing employers will be seeing their rates skyrocket upon the end of certain state orders. Reimbursing employers didn't receive coverage by the majority of states and have been greatly struggling to make payments. What are the states doing as employers are unable to make on-time payments?
So every day the states go to the Treasury. It's almost like the Federal Reserve supports the commercial banking system. And overnight, banks that have excess reserves lay them off in the Fed funds market. Every night, states go to their account in the Treasury and look at whether they're positive or negative. Either they're earning interest or they might have to borrow money. Right now, the borrowing is suspended. Reimbursing employers like nonprofits and government agencies, state and local government agencies, usually have to pay the full bill quarterly. So when the quarter ends, let's say in March, you have to pay in April, between April and July, April and June, your first quarter's bill. Fortunately, 50% of that has been paid by the CARES Act, 50%. And so the hope is that if this crisis is no worse than twice as bad as a regular crisis, the reimbursers and the state agencies will have the money to pay that. And the states are pulling back from the federal government whenever they can. They have records of the reimbursers. They pull back that 50%. And so those should be credited to the reimbursers' account. So their bills should be less than half. Many states during this crisis have suspended benefit charging so that instead of the experience rating systems working, what's happening is that there's a pooled sharing of these extraordinary charges. So most employers in many states will stay in their same position in the rate distribution, but the rate schedules will shift up. And so because the reserves, the rate schedule that's in effect is usually affected by the level of reserves in the system. So there's more risk pooling, and that's, as was mentioned, there's less reluctance by employers to let claims go through. But yes, the questioner is correct that tax rates will go up, but they'll go up less individually. So a lot of the companies that were able to work at home, their tax rates are going to go up as well. All right. So yeah.
Mm-hmm. So we have two questions that are looking really at the future of the system. One, Patty sort of refers to some of the automatic stabilizer or the automatic features that you could build into a system. And Griffin writes, to counter the disincentive effects of UI receipt, has any state experimented with any sort of benefit fade out, such as, for example, after 12 weeks of benefit receipt, at 50% replacement, decrease the benefits by some percentage each week thereafter? Is that something that would be consistent with the kind of automatic programs that you were referring to?
So it wouldn't be crazy if times were getting better.
Right.
I'd almost think of that would be more reasonable when we're in normal times, when you would expect people to be searching for a job, because you don't want people just saying, okay, I'm going to wait till the last second, get all my benefits, and then get a job. Not to bring up the New Jersey experiment again, but they actually, the bonus that was offered did decline over time.
Right.
That's the closest that I'm aware of an experiment with declining benefits, although I think there's some studies that claim that the optimal way, in normal times, to deal with the disincentives of benefits is to have them decline like that. That's sort of, I see that as a slightly different question from the automatic stabilization, where you want the amount of the benefits to respond to the macroeconomy. Now, it may be as things are getting better that in fact benefits are going down. And so you'd get that same effect because things are getting more normal at that time. What we really need is for the ramping up to happen automatically. As a market is crashing.
There was some of this in Europe. In Hungary, in Eastern Europe anyway. Hungary front-loaded the benefits, and I haven't really seen any good evaluations of that, Patty. I don't know if you have. I don't think that there was a strong effect. It was an avoidance of the total burden. It was a fiscal measure, really.
So I'm keeping an eye on the clock. We have two, I think, very important questions that may end up filling up the time. So I just want to make sure if we can get to both of them. This first question is for all of you. And I'll try to cut you off if we start running out of time so I can get the second one in. Chris writes, and he's a little bit negative here. He says, if we come out of the pandemic, I would prefer to say when we come out of the pandemic. What is the first priority to improve the UI system? Is it broadening eligibility? Is it funding requirements? Is it IT modernization? Is it something else? And is there another way to achieve this other than through a federal requirements for state program? Any takers?
That's a really huge question. Clearly, the experience of the last 5 or 6 months have shown several of the challenges that the program is facing. And I think to a certain extent, it might be all of the above or most of the above in terms of what really should be focused on in the future. I think the administrative issues are a challenge because no matter how great your program is, if you're not able to run it well, that limits your ability to achieve your goals. And so I think the increased attention on investment in the administrative infrastructure of the states is going to be very helpful moving forward, because we will have future downturns. We probably will have future federal programs, and it is complicated to program all of these little nuances. And the extent to which we can have a facile underlying architecture that can handle it a little bit easier would really be helpful. And I think the solvency issue is something that is huge and will probably cast a shadow for many years. And I think both in some of the presentations and some of the commenters, this issue has become really apparent, because I think in part, we saw not as many states prepared coming into this recession because they had barely gotten out of the hole from the Great Recession. And so that is a challenge. And then when you think about solvency, you really can't truly assess a state's efforts there without looking at both their revenue structure and their benefit levels, because of course, the more generous a benefit system would necessitate a greater funding source and in order to provide those benefits. And even along the lines to the challenge of tax rates going up, once again, it's, as Chris rightly pointed out, it's more going to be a matter of the whole schedule of tax rates going up to raise revenue rather than someone's experience rated tax level going higher because they caused more unemployment. So I think we're going to need to have a little bit more of a global look at a lot of the fundamental elements of the program.
Suzanne, sorry, Patty, Chris,
I'll
any first priorities?
Try to be quick because Suzanne touched everything. So I'll just echo what Suzanne said, but I think she's right. I mean, we need to improve the administrative systems, number one, the IT systems, and the customer interaction systems, the interface with customers. And as I mentioned, benefit levels are inadequate, but benefits follow financing. So we need to fix financing first with an eye toward incentives. Consider employee contributions, give employees a stake in the game, and then consider benefit reform in tandem with finance reform.
Yeah, I mean, not to keep harping on the macro stabilization function of UI, but I think the benefit adequacy is huge, but it's not clear that you can achieve this without federal requirements for the state programs.
Yeah.
Short of maybe Chris's idea that if workers had more of a stake in it, they would, sort of lobby for better benefits.
Let me make one point too, Patty, if I may.
And Chris, we have 30 seconds.
Well, the most severe crisis in recent memory, one of the preceding this was Katrina. And what the federal government did after Katrina in 2005, infused $400 million into the unemployment insurance fund for Louisiana. And that really stabilized Louisiana's reserve fund going forward. The federal government has to do something similar, I think, for states, but don't fund states that weren't prepared. Fund everything above 1 times the high cost multiple. So I think there can be a modest but effective federal assistance. Mike?
Great, and we have just hit 1:15, so I want to thank the panelists for an engaging discussion, for great presentations. I want to thank the folks in the audience for submitting their Q&A. I'm sorry we didn't get to all of the questions. Leigh, I don't know if you have any last words that you would like to say as we end this panel?
Sorry, no. Yeah.
Okay. So thank you again, and I hope everyone enjoyed these presentations and have a wonderful day.